the economy should be in recovery mode now. We have seen that many things actually bounce back. I could come up with 5 total reasons for why we are optimistic that 2026 would be a year where the economy would be firing in all cylinders. So there are 5 tailwinds. Number 1.
I'm very pleased to welcome back to the show Anna Wong. She's the chief U.S. economist at Bloomberg Economics. And Anna has been on the show several times in the past. I think, Anna, this is the first time I've had you on in a while. Welcome back,
Yes.
Anna. Good to see you.
Happy to be here again.
Happy to have you back. I've had your colleague Mike McGlone on several times. We've been talking about how gold has been running up. You were telling me offline how people are bullish on gold. I'll ask you about that towards later on in the interview. And I'll ask you why people are perhaps moving away from dollar-denominated assets. But first, let's get your outlook on the economy. You were previously quite bearish on growth prospects on the U.S. economy when I spoke with you last. Tell us about how you're feeling now.
Yeah, I think we have finally turned optimistic. So my view in 2023, 2024 was mostly driven by my read of the labor market that, first of all, doing a straight read of non-farm payroll is wrong. It will lead you to the wrong direction because of the overstatement in the monthly print from this birth-death model. So that was the reason why I was bearish in the last 2 years, because I think the underlying pace of monthly hiring, net hiring, was actually very weak. So that's in the past. And so we saw from the preliminary benchmark revision that BLS puts out before they enter into shutdown that the job statistics in 2024 may have to be revised down by 911,000, right? So that was one reason why we were bearish last year. But if you believe that, in fact, the labor market was not hiring. In fact, we had a couple negative jobs print last year, meaning that the recession has already happened. Then the economy should be in the recovery mode now. So our view is that there was a recession that started last year, and it went into a double dip this year when there was all those policy shocks in the beginning of the Trump administration with the trade policy uncertainty, the dovish. So the tariff shock itself is about a 1 percentage point fiscal contraction, and we think that the lowest point, the trough for activity, was actually around June of this year. So since then, when we looked at a large collection of statistics, we have seen that many things actually bounce back. When we look at alternative jobs data, I know you're going to ask me about the labor market situation later, but I'll just jump into that. So, most of the alternative labor market data out there are biased towards small and medium-sized businesses. And, in the last 2-3 years, small to medium-sized businesses could not hire people. They are outbidded by these large firms, and they could not offer the benefits and the wage growth. So now, when the labor market actually has some slack, the small and medium-sized businesses, they're actually hiring. So based on those alternative data, we estimate that, in fact, hiring by these smaller to medium-sized businesses were around 75,000 to even 150,000 per month in the last 2 months. Second, actually, I could come up with 5 total reasons for why we are optimistic that 2026 would be a year where the economy would be firing in all cylinders. So there are 5 tailwinds. Number 1, trade policy uncertainty. So trade policy uncertainty peaked in the first quarter of this year, and ever since has been coming down really sharply. And so when I was at the Fed, my colleagues estimated a investment model based on trade policy uncertainty, and I believe that the peak drag of trade policy uncertainty lasts about 3 to 4 quarters, and after that, it will subside. And so basically, that would say that the policy shock from trade earlier this year is peaking around now. And so by middle of next year, the effect that would dominate would be the improvement from, winding down of this trade policy uncertainty, which should unleash some of the pent-up investment. Second tailwind, fiscal. So I mentioned that the tariffs is equivalent to about 1 percentage point contraction, fiscal contraction this year. Well, next year, the one big beautiful bill would be generating an equivalent of 0.4 percentage point expansionary fiscal impulse by second quarter of next year. Third, financial conditions. So the Federal Reserve Board puts out a theoretically constructed financial conditions index that actually is in the unit of growth impulse. So as of the end of August, the financial conditions index is actually equivalent to generating a growth impulse of 0.5 percentage point in the year to come. So since the end of August, financial conditions have only eased further. So that, I think, it's basically easy financial conditions is generating a growth impulse of probably up to 1 percentage point next year. Why do we have easy financial conditions? On one hand, you have entirely independent AI story happening. It's lucky for Trump that all this policy experiment coincide with the AI boom that has been supporting everything. But really, a very key part of easy financial conditions is the Fed. And, in fact, if I have to pick all of the possible tailwind for the economy, the most important is the Fed. And we have estimated that the Fed's reaction function has shifted in a dovish direction. It is as if their inflation target is no longer 2%, but 2.8%. So given that the Fed is acting as if it will tolerate inflation permanently higher than 2%, and if you look at the Fed's projection, they have core PCE inflation above their 2% mandate for about 8 years before it closed the gap. So this means that I think the Fed would be, pretty accommodative to all this, growth impulse. Fourth, I mentioned the AI. The AI is an interesting thing because not only is there the element of how much capex can the hyperscaler continue to make, and based on their announced plans, we could see at least for the capex to be positively contributing to GDP throughout 2026. But I think another aspect of AI is that we see large firms now adopting AI tools, and that has led to slowdown in hiring in large firms and labor productivity improvement. And how that translates to macro statistics is primarily, number one, is higher unemployment, at least in the short term. And that would keep the Fed from raising rates, even though inflation would be going above 3%, because of this concern that this beginning of the labor market is something that could become nonlinear, when what it is really it's a productivity and AI story that's causing a pretty subpar labor market, at least in the short term. So that reinforces the rate cuts, which is also great for investment and AI capex. Finally, the fifth and last factor is just a cyclical recovery from 2 or 3 years of already activity that's actually subpar. Partly, we are seeing that, for example, the birth and death model that has contributed to labor statistics overstatement. Well, we're seeing business formation surging so far this year, and it seems like many of the new business formations are related to AI. So it's certainly in a when you see surging business formation, usually that is not telling you you're about to fall into a recession. Rather, it's telling you you're exiting from a recession or you're, going into a new business cycle. Another thing is this credit cycle. Now, as we were speaking, we just saw problems with two regional banks last week that led to some jitteries among investors over whether the credit cycle in the U.S. is about to worsen. Well, when you look at credit cards delinquencies, consumer loans delinquencies, auto delinquencies, the peak actually has passed. And if you look at the longer time series of how these delinquency rates behave, they always peak during a recession, and it only falls after a recession has ended. So all those delinquencies are telling you that the worst is over, and even with regards to credit. So I think all this means that 2026, at least, this party has at least one more year to run.
Before we jump back into the video, let's talk about something most people ignore: online privacy. Now, your personal information isn't just sitting on your phone or email. It's being scraped, bought, and sold by data broker websites every day without your permission. Our sponsor today, Delete Me, helps you take that control back. They scan the internet for your exposed information, send you regular privacy reports, and remove your data from hundreds of broker sites so it can't be used against you. Take mine, for example. In the latest report, they reviewed over 325 listings to see if any data brokers had my personal information, and they continue to check every week to ensure that it stays off. Go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout, link down below, or scan the QR code here on the screen, and you'll get 20% off of all US plans. Take control of your privacy today before somebody else does. What happens to inflation once everything starts to recover? We're already at 2.9 headline CPI. Right now, the concern is that we can go even higher than that, and the Fed will be forced to put things on pause, so to speak, in terms of their pivot strategy. That may slow down growth.
Yeah, so I mentioned that a key part of our optimistic story is the role that the Fed will play in accommodating all these things. So our forecast is for core PCE to hit 3.0% at the end of this year and heading to only upwards next year. So we have the unemployment rate peaking at 4.4% in the first quarter of next year, which means that the core PCE would fall to perhaps 2.9 or 2.8% in Q1. But then thereafter would continue its upward trend, finally reaching about 3.3% by the end of next year. Now, I mentioned that the reaction function of the Fed, when we reestimate it, it looks like they are okay with higher inflation for a more sustained period because they're embracing the transitory inflation argument again. So I think that they would accommodate inflation up to a little bit above 3%, especially if unemployment rate were to keep trending up. And this is the whole thing of why AI actually and the labor market impact from AI, which is reducing hiring, actually is very bullish for the economy because it keeps the Fed from responding to the inflation part of the mandate and squarely focus on the weakening labor market fundamentals. And however, we do see the Fed hiking in 2027 as a result of inflation going above 3.3% next year.
And the Fed will still be inclined to cut rates at a time when the inflation rate is around 3%, which is a whole percentage higher than their target?
Because the unemployment rate is climbing.
Not because Trump is making them?
Well, at this point, it's kind of indistinguishable who is doing what. I mean, when we estimated the new Fed reaction function, we found that the dovish tilt actually began in middle of 2024. that coincided with the trough of inflation as well. When you look at inflation, it bottomed in around June of 2024, and thereafter has been going up. So this dovish pivot in the Fed actually preceded Trump. So they were 50 bips to lose last year, and at the end of this year, with 50 bips of cuts to go, they're going to be about 75 bips to lose by the end of this year.
The five pillars, or I guess reasons for why you're turning bullish, those were all a gradual sort of evolution of data throughout this year and last year. At what point this year did you decisively turn more bullish, and why?
Yeah, so first of all, seeing the bottom in the labor market. Why do I think we saw the bottom in the labor market? So we rely on an alternative data provider named Homebase to forecast our jobs estimate, and we have been very accurate throughout the last 12 months. So strangely, in the last 4 or 5 months, that model we rely on consistently was too optimistic about the non-farm payrolls. And so I think, whereas last year, if you look, if you don't do any adjustment to the non-farm payroll, the home base data would suggest everything is much weaker than the official non-farm payroll. But this year, the picture is flipped. So this forecast error, which is persistently on the positive side, makes me think that, in fact, small businesses are coming out of 2 or 3 years of blues, small business blues. And so that's one reason. Second, many of the 5 factors that I mentioned reflect some sort of economic modeling in the background, knowing how each of these 5 variables affect the economy. And basically, all of these negative shocks to growth happened this year. You know, David, it's very rare, even in the worst of kind of financial crisis, could a negative GDP growth or recession last beyond 3 quarters. Like when you think about 2008, and even looking at Russia, when it was sanctioned by the U.S. economy back in, I think 2014, a contraction. After the contraction, you start to feel everything rebounding because things just cannot keep contracting for more than 3 quarters. And we definitely saw a weakness starting 3rd quarter of last year, extending to 4th quarter of last year. In fact, the weakness began around April, May of last year. And then we had another, very serious shock in the 2nd quarter of this year. So all the cyclical changes suggest that there is a very big recovering force, especially when the Fed seems to have very little willingness to go against Trump or to be hawkish.
I remember 2 years ago when you were on the show, we were warning us about what the Airbnb collapse or the lack of rentals at Airbnb would signal for growth. How has that changed now over the last 2 years? In other words, are consumers spending money on discretionary travel and goods right now?
No, they are not, David. It's not Airbnb. It's not doing well. This is so I think implicitly what you're asking is this K-shaped economy. People are now talking about and how there's half and half not in this economy. On one hand, you have the top 20% of the household who own most of the stocks, and they're happy because they're enjoying this rally. On the other hand, you have the bottom 50% who have student loans, who have car loans, grocery prices are high, and they're just not doing well. And moreover, many of these government transfers that they could relied on during the Biden administration is no longer. If they don't pay back the student loans, their wages will have to be garnished pretty soon. And many of these state and local government transfers that they receive from the federal government are also expiring this year. So I think that but whether these would translate into a drag on growth depends on how systemic they are in the economy. So, by what I mean is, I see the have not part of this economy as more of a financial stability risk as opposed something that would knock off the GDP growth. Because the GDP growth right now is driven by investment, AI investment, and wealth effect. As long as those two key support of the economy keeps going, they could reinforce each other, the wealth effect, stock market, AI. But then the have not, we've seen recently Tricolor imploding, and then First Brand. Both are related to autos. Tricolor is related to subprime auto loans. And so you look at the details of what caused these small, tiny cockroaches running around, as Jamie Dimon would say, for the subprime auto. Well, he warned last week that the two regional banks are cockroaches, and that there may be more, right? And these are, I think, the Tricolor, First Brands, and the two regional banks are causing some discomfort among people who are normally more bullish, because you don't know what's hiding or lurking behind. And the reason why I'm cautiously sanguine about this is when you look at the details of what caused these subprime auto delinquencies. They're the people who bought cars in 2022. They're the people who were probably going on Airbnb vacations in 2022, but no longer in 2023. So in fact, auto delinquencies, the most predictive factor for going delinquent on an auto loan is the size of your monthly payment. And between 2020 and 2022, used cars went up by 30%. And thereafter, used car prices came back down. So, and we know also that in the people who were buying cars in 2023 and 2024, their credit score were much better than the ones who bought cars in 21 and 2022 with the government checks. And most likely those are the same people who also were taking up the forbearance from student loans also. So now those things are coming due. But if you do believe that the credit profile of car loan borrowers after 2022 has improved, which I think is indeed true, then auto's delinquency should have already peaked, which, according to the data we're seeing, has indeed already peaked. And usually, these delinquency rates peak inside a recession, and they only fall after a recession is over. And now across these, consumer loans, credit cards, auto delinquencies, all of them have peaked and has been falling in the last quarter or two.
So where I'm going with this is I'm wondering how resilient or fragile this economic boom or growth, should I say, is going to be. Because if the top 20% hold the majority of stocks and they're happy right now, well, they will be presumably unhappy if the stocks do correct for whatever reason. Those people, according to some economists, are going to spend less if the capital markets see a downturn. And then that's how you get a recession. It's not from, the stock markets aren't going to correct from a recession. It's the other way around, is what some people say. Do you agree with that?
Well, I agree with the exact mechanics. So indeed, it's true that the top 20% account for a larger, are the marginal spender. So what decisions when they decide to rein in their spending, you will get that impact on GDP growth. But the question is, will they? I mean, if we have this, so which one is chicken and the egg? Which one is it? Who's the primary force? And I have to go back to the Fed. As long as the Fed is cutting rates, I could see this K-shaped economy sustaining. Well, I would take you back to an academic paper actually that tried to explain why Treasury rates was secularly going down in the 2000s. One explanation is inequality. Inequality actually means lower R star, and that is because of that mechanism you just described. The wealthy people, they have a lower marginal propensity to consume because they tend to save more. And whereas the people who are not as well off, they live paycheck to paychecks, and their saving rates doesn't move that much. They basically doesn't save that much. And if you give them extra stimulus checks, they spend it, right? So if the savings is concentrated in the wealthy, and the wealthier people are getting wealthier, what you should be seeing is that the saving rate in the country should be higher. I mean, given the propensity to consume, and which is why worsened inequality tends to mean lower R star. So I think, as long as the Fed has adopted this new dovish posture, being excessively dovish, in fact, then I'm not saying that they made the right policy choice, but it's the choice that they seem to have made. Then this economy could keep going.
Going back to your earlier point about how the labor market has bottomed, last year you told me that the unemployment rate could stabilize around 5% and then go back down sometime in 2026. Are you still maintaining the 5% target? We're still right now at 4.3%.
No, we have lowered it from 5 to 4.4 for 4.4 around Q1, Q2 next year. And the reason why we have lowered our unemployment rate forecast is, number one, the immigration crackdown was larger than we thought. And this led to a tighter labor market. That's number one. Number two, the wealth effect that this AI boom just came out. So the AI boom started really showing up in macro data in the first quarter of this year. So we calculated that AI-related CapEx contributed 1 percentage point of the 1.6% average growth in the first half of this year. So that is much larger than we thought. And finally, one assumption that changed, which I held last year, which I think is which is very different today, is the Fed. So last year, I thought that the Fed, being intrinsically more biased against the Trump administration, would hold rates higher for longer because of their fear of tariff-driven inflation. Not that we predicted tariff would lead to high inflation this year. We were actually one of the few groups that didn't see the tariff as driving up inflation this year, but more because I think the Fed would have misjudged the inflationary pressure, and therefore they would held on to rates throughout until the very end of this year. But it turned out that they capitulated faster than I thought, and they whether this is a reflection of the pressure from Trump or from just the soft landing Powell, that Powell just really desire a soft landing. I don't know, but the point is that their reaction function has clearly shifted in a dovish direction.
Let's end on tariffs now. The effect of tariffs on economic growth, have we already seen that play out, or is there going to be a lag effect? And I ask this because Trump is still threatening a 100% tariff on China, set to take place on November 1st if he doesn't cancel that before November 1st. And I'm wondering whether or not, going back to my question, tariffs will have an immediate impact on economic growth if they do escalate, or have we already seen that impact play out?
We have only seen part of it play play out. So when you think about how tariff shows up in various price measures in the economy, first it comes through imports. So import prices is where you look at these things. And what we see is that importers bear almost 95% of all of the tariffs. So basically, the US side is taking the brunt of the tariff. Then the next question is, did these importers pass on all these costs to manufacturers, wholesaler, retailers, all the intermediary firms? And did these intermediate firms pass on the cost ultimately to CPI? So we look at the CPI and we have seen that for every $1 increase in tariff, there's about 0.3, so 30 cents of increase in consumer prices, which means that almost 70% of the tariff costs are absorbed somewhere between the end point of the consumer prices and the import prices. So it's absorbed through profit margin compression of the intermediate firms. Now, in the earnings, Q2 earnings, we have not seen much evidence of firms' profit margin compression. Though you have seen some of these consumer-facing companies like Home Depot, Target talk about costs increasing. But at the same time, I think that tariff pass-through is not a static thing. It's really about pricing power. And this year, as I said, the tariffs is equivalent to a tax hike that's generating 1 percentage point contractionary fiscal shock. So there's just no pricing power because consumers are experiencing a massive income shock. So where firms will find better pricing power is in a recovery when things are improving and when consumers are feeling more willing to spend. So this is why I do think we didn't think there would be too much pass through this year, but the story is not over. The story will continue next year and next year, especially if the economy will be firing in all cylinders in 2026. It will mean that many firms will want to pass through those tariffs next year.
Final question, Anna, before we go. What would change your mind again and make you more bullish? Or bearish, more bearish. Yeah.
I think the key unknown is the credit market. I explained why I didn't think that there's a massive amount of cockroaches hiding in the kitchen because of the how we look at auto delinquencies. However, who knows? Usually these balance sheet shenanigans do not come up to the surface until one thing go bust, and it turns out that there's more linkages between that thing to another thing, and private credit is a very shadowy corner of the market. And then if something happened in the credit space that lead to a stock market popping, so one thing leads to another, credit market spills to the equities market, then if we are seeing a widening of these contagion, then I would change my mind. The Fed could also, of course, as I said, the most important thing is what the Fed will do. So suppose that the Fed make a policy mistake by not responding to these market events and we're too slow. Recall that when Silicon Valley Bank imploded, the Fed was very quick to offer liquidity, right? And that was what made that period of turbulence very brief. And then suddenly everything was fine again. So at the end of the day, it is the Fed's response. Even if you have a big credit shock, as long as the Fed put is there, then it will be a very short-lived type of shock. So really, at the end of the day is the Fed. What if the Fed suddenly turned hawkish for whatever reason? But it's kind of hard to see the Fed turning hawkish right now, absent a really shockingly big inflation print.
Okay. Anna, thank you very much. for this report. We'll follow up soon and see what happens in quarter four of the remaining of the year. Thank you very much again. Where can we follow you?
You can find me on X. My handle is at Anna Economist. Also, you can find us in the terminal, Bloomberg Terminal. If you go to BECO Go, you can find our writings.
Okay, very good. Thank you very much. We'll see you next time. And don't forget to follow Anna, link down below. And don't forget to subscribe to this channel.